In all my years of trading the financial markets and teaching option strategies to tens of thousands of students worldwide, I have found one simple option strategy that is absolutely perfect for beginners. It is the humble debit spread. Now, there are a ton of different option trading strategies out there, but I like teaching debit spreads to beginners because, one, it doesn't require a lot of capital to execute, and two, we can limit our downside risk, our losses, if the trade goes against us. So this strategy is ideal for beginners, and this is one option strategy that you can take to the bank. Hi, I'm Noah Davidson with the Cash Flow Academy, and the debit spread is a trend trading strategy. In a bullish market, we can use a bull call debit spread. Bull because we're bullish, call because we're going to use call option contracts, and it's a debit spread because we're going to buy a contract to control the right to the stock, and then we're going to sell a higher strike price and get paid in advance for making a promise to sell the stock at that higher price, and we wind up with a position called a bull call debit spread. And so ultimately what we're doing is we're using contracts to control the underlying asset at a fraction of the cost of owning the stock. So in this example, we're going to look at a stock that I believe has reason to rise in price, meaning there's a good reason for this stock price to trend higher. The stock we're going to talk about is Nucor. Now, this stock, it's not an advertisement to buy or sell Nucor. I like Nucor. They are a fundamentally sound company. They are a steel manufacturer and producer, and I believe that the stock price is going to rise due to the general speculation that AI spending, the massive amounts of capital being spent on AI right now, includes infrastructure build, and infrastructure requires steel. So this is an AI infrastructure play, and over the long run, Nucor is likely to go up in price, likely to go up in value. What we're going to do here is speculate in the short term, which means we have to be right about the direction that the stock price moves. And if we are right, we stand to make a really tidy profit. So let's check it out. So here we are, we have Nucor. It's trading just shy of $150 per share. And I'm going to round the math off to make it easy for us right now. It's trading right here just shy of $150 per share. And option contracts are good for 100 shares of the stock. So if I wanted to control 100 shares of the stock, it would take $150 per share times 100 shares, or $15,000 to control that asset long term, to own it. I would be entitled to the dividends. I would be entitled to any upside growth. I also would be exposed to any downside risk. Now, in the near term, I believe this stock over the next 2 months can rise up towards a profit objective of 170, which means we could potentially sell that stock for $170 per share, again, times 100 shares, so that would be $17,000, and that would leave us with a nice and tidy profit of $2,000, which would be an awesome return. If you were to take the $2,000 and divide it by the $15K we put in, that would end up being about a 13.3% ROI on capital used. That would be a great feeling. Now, of course, if the stock can go up, it could just as easily go down. And what if the stock fell 20 points down to 130 instead of rising up to 170? We could feel some short-term acute pain. And that means the value of that $15,000 investment would drop down towards about $13,000. And that would be a drawdown of $2,000 to the downside, and again, a 13.3% drawdown on the account. And that wouldn't be a great feeling. That would kind of hurt in the short term. And again, long-term temperament investors, you'll be fine owning the stock, but short-term traders, the stock price oscillating up or down can leave you feeling great when you're winning, or it can leave you holding the bag, hoping and praying the stock price rises again. Now, what we're going to do is, instead of tying up all of our capital buying the stock, we're going to use some contracts to control the stock. And this is how we're going to approach it. We're going to use that same $150 strike price. $150. We can purchase a call option. We can buy one $150 call option for the month of January. And that gives us just a little over 2 months for the stock price to rise. And that contract is going to cost us about $8 per share, which times 100 shares for the contract would equal a debit, meaning out of our pocket we would have a debit of $800. And that's the most we could technically lose because the contract could expire worthless, and we would have $800 out of pocket for a contract that ends up being worthless if the stock price doesn't go up towards 170 where we think, or even if it doesn't stay above 150. Now, I think, again, the stock price is going to go from where it's at right now, 150, and believe that the stock price has a good chance of rising up to our profit objective of 170. And what a call debit spread does is we can make a promise in advance to sell the stock at 170 and get paid right now. And what we would wind up with is we could sell one $170 call option for January, same expiration date, and we could collect about $250 per share, or we would end up with a credit of plus $250. So we would spend $800 on the contract, giving us the right to buy the stock at 150, and we would receive $250 for making a promise to deliver the stock at 170. And so out of pocket, we would wind up with a net debit of $550. That's the most we could technically lose. And if the stock price never went up and the options ended up expiring worthless 2 months from now, and we didn't make the choice to sell those contracts or exit those contracts by getting rid of them, but selling back the one we bought, buying back the one we sold, we could end up again with a maximum loss of $550, which is nice. That's not that much. And it doesn't, again, take that much capital. Now, if the stock price, again, rose from 150, again, we have the right to buy it at 150, and that's a right, not an obligation. And we have, again, made a promise to sell it out at 170. The most we would make is the 20 points between those two. So again, the profit would still potentially be $2,000 if we bought it at 150 and sold it at 170. But the price of those contracts, the actual out-of-pocket debit, was still $550. And so we would have that $550 expense. So our maximum gain would be the $2,000 minus the $550 debit, leaving us with a maximum profit of $1,450. That would be our maximum potential gain. Now, $1,450 is less than $2,000 of profit, but the amount of capital we put in was only $550. So if we took our $1,450 profit and divided it by the $550 of capital we put into the trade, that ends up being a 263% maximum ROI. Now, 263% is massive compared to the 13% ROI on capital used. The stock price didn't go any higher. Using the debit spread allowed us to put less capital into the strategy. And so, again, we have maximum risk of $550 and upside potential still $2,000, but once we take out our expense of the $550, we walk away with a maximum gain of $1,450, and we laugh all the way to the bank because our ROI on the capital used was 263%. Don't be greedy. So there you have it, folks. That's a nice little introduction to a bull call debit spread. As you've seen for yourself, it's a really cool little strategy where we use those options contracts to control the underlying asset. Again, giving us the right to buy low and a promise to sell high. And when we build good debit spreads, we have that potential to reap big rewards. 263% returns don't just fall out of trees. And if you're new to trading and investing and you're new to options, you don't just run out and willy-nilly start buying and selling options thinking that you're building good debit spreads. That is a skill that takes time and effort and energy to develop. You want to get yourself educated first. Make sure you understand all the basics, all the ins and outs of those contracts, how to control and limit that downside risk, and how to optimize for the potential profits, giving yourself that edge that traders always need. So again, spend more time with us here at the Cash Flow Academy, making sure you have all those basics down, all the rules and the criteria to help keep you safe so that you too can execute really cool trading and investing strategies like the debit spread. Education is essential for success with option strategies. So spend more time with us here at the Cash Flow Academy. This video right here is a great place to start, making sure you have more of those basics dialed in under your belt. And we will see you in the next video.